Hello, and welcome to the Stock Up with Larry Jones show. Wait a minute, you do not look like Larry. No, my name's Ashley, and I run the Trading with Ashley channel. I'm a friend of Larry's, and I'm very grateful to Larry because it was Larry's videos that actually gave me the confidence to start trading in the stock market. Eventually, I learned enough that I was able to retire young, and now I trade for a living, and I run my own YouTube channel. So it's an honor to be able to be on Larry's page and help all of you learn selling options. Larry cares about all of you and all of your portfolios, so he asked me to come on today to share with you some of my strategies for protecting your portfolio. Now, the best time to prepare for protecting your portfolio is when the stock market's green. That's when you have the best chance at building the funds that you need so that you can enjoy the eventual downturn when it comes. For those of you that have Larry's course, Stock Up You, I will be adding some chapters in there here soon that actually help you with these techniques. For those of you that haven't purchased his course yet, you may want to consider it. It's one of the most extensive courses that I've ever seen, and I'm honored to be able to add a little bit of content to it. I know all of you care about Larry just like I do, so make sure you put a coffee cup in the chat. That will go a long way. He will see all of your comments, and it will mean a lot to him during this time. I have so much to share with you. I actually run an active trading community, and I go over all of these things with them, and it really helped them last week when we had a market downturn. So I hope that you find this useful. One, we are going to talk about how much cash you should keep to the side so that you can strike when the price is right. How much cash should you have waiting in the wings? I always encourage my students to have at least 25% cash waiting in their broker ready to strike when stocks pull back. Now, you will use this cash over a period of time so that you can dollar cost average when a stock is going down. But if you have it there ready to go, it's much easier to catch these stocks when they're super inexpensive. A little later in the video, we will go over exactly what price to look for so that you know where to set your limit orders if you plan to use the cash to buy some of your favorite stocks. I am going to share with you how to know if you are entering a stock at the right price. We've always been told to buy low, sell high, and I am going to take you through the technical analysis I use so that I can choose the best possible entry for a stock, and then I can enjoy the stock appreciation. Also, I am going to share with you everything you need to know to set a proper trailing stop loss on your stocks. It's one of the favorite tools I use to protect my stock gains. One of the favorite strategies I'm going to share with you today is how to properly sell a covered call against your stocks. Now, if you have 100 shares or more of a stock, you can sell a covered call. The best thing about a covered call is you actually make money when a stock pulls back. Also, if you sell a covered call above the price that you purchase a stock at, you cannot lose in that transaction. Now, a lot of you are aware of how to purchase a put or a call, but the reason I like selling puts and calls is I'm the benefactor of the time decay. So if you purchase a put or a call, the stock basically has to go in your direction and pretty fast. If you sell a put or call, you have the luxury of time to let the trade work in your favor. And if the trade works against you, there's several things you can do to recover from the trade. The benefit to selling puts and calls is you actually can win in 3 different scenarios. And if the trade works against you, there's a lot more I can do to recover from the trade versus buying puts and calls. So I hope you find today's lessons helpful and it opens your mind to a new way of trading. I'm going to take you into my portfolio. I'm going to take you into the charts. I'm going to show you everything you need to know. Before we get started with doing a covered call on NVIDIA, the first thing we want to do is go look at our trade and make sure it's in profit. So here you can see I have 1,000 shares of NVIDIA, and this particular trade is 33% in profit as we speak. So as long as I go above the current strike price, which is 122, if my shares are called away, there's no way for me to lose money on this trade. In fact, if the price of NVIDIA pulls back from my strike price, let's say it's at 122, then I will keep all the premium paid to me and I will keep all my shares. So if you have a lot of shares, you may decide to do a mix of strategies. Maybe on 500 of my shares, I'll sell covered calls, and then I might do a trailing stop loss order on the other 500. You can mix and match your strategies as you see fit. But before I settle in on that 122 strike, let's go look at some technical analysis on the trade so that we can best determine where the perfect spot may be to have our shares called away so we don't leave too much money on the table if NVIDIA decides to keep running. I like to look at Yahoo Finance because I like the way that their chart is laid out. Now, what you are looking at is the 3-month chart on NVIDIA, and I have the Bollinger Bands populated. The Bollinger Band is this gray area right here, and it is a predictive model on where it thinks the stock may go. And typically, a stock likes to stay under the cover of the band. Every now and then, you will see that it comes outside of the band, like you see right here on 8.5. It came below the band, but it didn't stay there long before it retreated back up. Then, if you look a little bit further out, you can see over here back in May, the end of May and early June, the price action was above the Bollinger Band, but it wasn't long before it came right back into the band. So this can help give you a really good idea of when a stock may turn around and retreat. The other thing I like to look at is this number right down here. This is the Relative Strength Index, the RSI, and it tells us how strong a movement is on a stock. Anytime this number is close to 70, you can consider that stock as overbought and more than likely it will start to retreat. One thing that you will notice is if this is close to 70, then you more than likely will be at the top of your band. So I want to select a strike price at the top or right above my band in case I don't want my shares called away, or if they are called away and I have to give up my shares, then if I'm at the top of the band, more than likely I can go repurchase those shares for the same price that they were called away, or maybe even a little lower. Or I can start to sell puts. Puts are for another video. Right now we're focused on selling calls. So I am looking right here at this $130 mark. I think that would be a great strike price to consider because it is above my band. Now, how far out do you go? The reason you don't want to go too far out if you are selling a call is that typically stocks, and especially strong stocks like NVIDIA, have a tendency to want to rise over time versus pull back. And so you don't want to go too far out and have to watch the stock continue to rise past your strike price, which would mean you're leaving a lot of money on the table. So with that being said, I'm going to go out 1 week and look at the $130 strike price. Let's go to an option chain to look a little bit closer at the dynamics at play. When you get to your option chain, you will notice that calls are on the left and puts are on the right. And as you know from earlier, you can buy puts or calls or sell puts or calls. This is concentrated on selling calls. I had decided I wanted to go out 1 week, so that would, at this time of filming, would be August the 23rd. Once I populate that, I come down on my chain and I start looking at different strike prices and what I can get. I had settled on the $130 strike. Well, looking right here, it is offering 94 cents a share, and every time you sell a call, you're referring to 100 shares, so this would be $94 a contract. You would simply take this price right here, now it's 95 times 100 to see how much you would be paid for agreeing to give up your shares at the strike price you selected on the date that you selected. The next thing I want to look at is the delta. It's right here and it's 0.2. Now the delta is my favorite Greek because it gives me so much information to help make the best decision. Right here is showing 0.2. This is telling me two very important things that I will use to make my decision. The 0.2 is representing about a 20% chance that on our expiration date, 8/23, that NVIDIA ends up hitting this strike price of 130. So 20% chance of it hitting 130 means that there's an 80% chance that it won't get to 130 and that I will be able to keep 100% of what I'm being paid to make the trade, and I would be able to keep my shares in that case as well. So I like that because that's a win-win. I get the money for the premium and I get to keep my shares. The other thing that Delta is showing us is that right here, this 94 cents, this will change by 20 cents a share for every dollar that NVIDIA moves from the time that I actually sold this call. So it's very interesting because this will let you know how much more or less this will become as NVIDIA continues to rise or fall. The other thing that stands out to me right here is this volume and open interest. Notice that this has 43,000 in volume and 36,000 in open interest. If you look around it, there are no other strike prices that have this much activity. You can go up here to 125 and you have more activity up here at 125. But if you're going to 130, this is where all the action is. So you could do one more thing to make your trade a little bit safer. I like to envision this as the cavalry. I like to envision these 43,000 and 36,000 individuals fighting back the enemy. If that's the case, then you'd want to align yourself behind the enemy lines right here. This would put you at $131 a share. Because more than likely, if the price gets to 130 and all these orders start triggering, it's going to push that price up further. That would allow you a better chance of keeping the premium if the price gets to 130 and then starts going down. Here, if I decided to go with the 131 strike price behind all this action, I would receive 80 cents a share, which would be $80. So I'd be giving up a little in premium, but if it got to 131, I'd be gaining $1 more in the stock itself. So that might be a great point that I'd want to align myself and sell the $131 strike. Because ideally, when we get to the end of the trading day on 8/23, then NVIDIA would settle in anywhere below 131. I would be able to keep 100% of this and keep all of my shares so that I could then sell calls the next week. So let's go actually make this trade so that you know the actual keystrokes that you'll need to do if you decide to sell covered calls against your shares. Now, we had looked at the option chain earlier. You can go and look at it again if you prefer on this platform, but I know what strike I'm interested in, so I am going to do sell to open. Now, I wanted to explain this because you do have 4 choices here, but this is an easy way to remember it. Because you are going to be getting money for this trade, you're selling something, so that narrows it down to sell to open and sell to close. Well, sell to open is what we're doing because we are opening up the trade. So that might help you remember what to select right here. You're selling because you're getting money for it and you're opening the trade. I am going to sell one call option in this scenario. This represents 100 shares. The expiration date is going to be August the 23rd. That's 1 week from now. I had decided on that $131 strike price. So let's go take a look at that and grab that one. This is a call that I'm selling. And now it starts to populate everything. Now, one thing I do really appreciate about this particular platform is right here. This is on the Merrill Lynch platform, and it does show me the day's range for the premium. So this shows me that the lowest amount of premium that was being paid today was 35 cents, and that must have been earlier before NVIDIA had run as much as it is right now. And then at the height of the day, it was paying 93 cents. So that must have been when NVIDIA was at the height of the day. But the simple fact that we're at 74 cents right now is in the upper quadrant for the day. So I feel like that would be a fair trade. So what I would do now is I would select a limit order because I want to make sure that I get at least 74 cents for the trade, or I could actually go 1 cent higher and see if I could get 75 cents for the trade and just wait for NVIDIA to push just a little bit higher. And then I select day. I could do good till canceled, but I really don't want this trade going several days because if NVIDIA is going to run after hours, then I'll just take the trade tomorrow versus being locked into it. Now this right here shows you your estimated gain is $75. This is the premium that you'll receive for holding your shares back so that someone can buy them if it gets up to 131. Now this right here shows unlimited loss. I don't want this to scare you. This is if you are doing naked calls, meaning you don't have the shares to back up the trade. So we don't have to worry about this because I do have the shares to back up the trade. Then you would preview order, make sure everything's in line. This particular broker does charge a little commission, so that shows right there and it's deducted from the total. And then you submit the order. And look, I put $75 and I did get it filled at $75. So even though it was trading at $74, I was able to get $75. So that's where a limit order helps you. Now that I have made the trade, you can come here and watch your trade and see how it adjusts. But what's really most important is where it ends up on your expiration date towards the end of the trading day. Now remember, I received 75 cents, so NVIDIA must have run a little since the time I did the trade. Now it's offering 76 cents. So I could have maybe put a higher number in and got it filled. And so this is showing me right here, it looks like I'm losing 66 cents on the trade, but I want you to keep something in mind. This is really not a loss at this point. It's just a lost opportunity. Basically, what this is showing me is, had I just waited for NVIDIA to move up just a little bit higher, I would have been able to get another 66 cents. And so I don't want you to see this as a loss as the trade is moving up and down and feel like you're actually losing money. Remember, if my shares are called away at 131, I paid much less for them, so I cannot lose on the trade. And I get to keep that 75 cents regardless of if my shares are called away or not. So you've got to keep that in mind. So really, if you think about it, I'm still ahead on this trade because I did receive 75 cents a share. And right now, it's just down 66 cents a share. So that's important to keep in mind if you're monitoring your trade. So what will happen on expiration date if we get to the end of the trading day and NVIDIA is below 131? Then you will notice this 76 cents will whittle down to zero, meaning it has no value anymore. And that's good for you because it had value at the time that you sold it. That means you'll keep all the money that you made and you'll keep your shares. Now, if your shares are called away, you will receive not only this $75 that you received at the time, but you're also going to receive all the money between the point you purchased NVIDIA and 131 giving up NVIDIA. So now you're going to be sitting on a pile of cash, which is great if we're in a bear market because having cash is king in those scenarios so that you can then use that cash to go buy the stock much cheaper. The next thing I'm going to show you is called a trailing stop loss. And I love trading this way because it really does help you get the best possible price for a stock if it starts to pull back. Let me explain. When you get to the order ticket, you'll select the action of sell. You put in your ticker symbol right here. Now I have 900 shares to work with, so I can decide how many I want to do a trailing stop on. But let's assume I want to do 150 shares because I'm doing a variety of different strategies. If that's the case, then here's how it would work. Currently, NVIDIA is at 122. When you're doing a trailing stop, you have lots of different options. I'm going to focus on the one that's the percentage here because it will execute if it drops down by a certain percentage. Because I'm in profit, I don't want to take out my shares too soon. If I didn't have as much profit, I might make this a tighter stop loss, but I'm going to put 8%. And this shows you down here that if NVIDIA pulls back at this point to 112, it's going to automatically sell my shares for me. And I would make the duration on this good till canceled so that it'll follow the stock through the ups and downs. Now, the beauty of the trailing stop loss is just that it trails the stock. So today we're sitting at 122. But if I keep this trailing stop loss on it and next week NVIDIA gets up to 130, Then it will only execute if NVIDIA pulls back 8% from the highest point. So that would be 130. So that's the beauty of a trailing stop loss. It follows your stock all the way up and only activates if the stock retreats by the percentage you set. Next, I want to show you what to do with all your cash if we're in a bear market. You ideally want to get stocks on the cheap, and I'm going to show you how you can select the best possible price for a stock. This will help you know where to set your limit order. Going back to our technical analysis chart, if you look at the bottom of this band, you will notice that NVIDIA has a $97 price point here at the bottom. Now, anytime you can get a stock at the bottom of the band, that is a great trade because, like I said, if it's a quality company, you will be able to enjoy the price appreciation as it goes all the way up. Now, I have one member in my community that was so savvy. He set all of his orders for the bottom of the band, and then when we had the flash crash last Monday, all of his orders triggered, and he picked up some really great quality names at some incredible prices. So he is sitting on significant gains right now because he had a limit order set at the perfect price point that was below the bands. So seeing that this is 97, I'd be happy picking up this stock anywhere close to $97. So now let's go back to the exchange and let's set us a buy order now that we have a little cash to work with. So now let's go back to the exchange and we're going to set a limit buy order, assuming you now have a little cash to play with. Let's assume at some point in the next couple of weeks, this triggers and it sells my shares for 112. Well, okay, that's a done thing. Now I want to go set my order to buy them back. So here is NVIDIA. I want to buy back 150 shares, but remember, I want it lower than where it sold them at. So now I am going to go and I am going to set a limit order. I've decided that price that I'm comfortable with is $97. So I put that right here, $97. And then on the duration, I want to do it good till canceled. It will buy the NVIDIA shares, 150 of them, only if it gets down to $97, good till canceled. And this shows the amount of cash that it will take out of my broker to purchase the shares. But remember, I just sold 150 shares, potentially at $112. So it would not even take all of the money that I have in my broker to make this purchase. That's how you get ahead when the market pulls back. You buy these stocks inexpensively, then you sell them higher. It's called swing trading. I hope you were able to learn a lot today to protect your portfolio. And I want to personally thank Larry for giving me the opportunity to come on his channel and teach all of you. If you want to learn more techniques like this, don't forget to hop on over to my channel and press subscribe. There's so much more I want to teach you.